All right, welcome to this explainer. Today, we're diving into a full-on, enthusiastic masterclass on exactly how corporate leaders construct, survive, and ultimately scale their businesses. We are going to explore the ultimate corporate blueprint, and we'll do that by blending the qualitative, somewhat messy art of strategy with the incredibly precise, quantitative science of finance. Think of it kind of like taking the CEO's grand vision and wiring it directly into the CFO's calculator. Okay, let's dive into this. We've got a tight structural blueprint to follow today that's going to demystify some truly massive corporate hurdles. We'll start by charting the strategic course, then analyzing the corporate battlefield, fueling growth through capital budgeting, navigating risk and uncertainty, executing the master plan, and finally rewarding the shareholders. Section 1. Charting the strategic course, the vision and the blueprint. Let's go ahead and put you right in the CEO's chair, ready to set your company's ultimate compass. So before a single dollar is ever spent, a company desperately needs a direction. Now, you might be thinking of strategic management as just another corporate buzzword tossed around in board meetings, but it's absolutely crucial. It's a vital survival mechanism. We're talking about the discipline of shaping long-term direction, building a real competitive advantage, and guiding the whole organization through some incredibly turbulent environments. This entire process literally starts with clear intent. You need a vision of where you're going, a mission of what you're actually doing today, and concrete objectives. It's really about steering towards survival right now while embedding the core competencies that guarantee your advantage tomorrow. Section 2. Analyzing the corporate battlefield, looking outward and inward. This is where we move from that high-level, big-picture vision to a rapid-fire analysis of the actual, messy terrain where your company has to fight to survive. Because obviously, you can't build a strategy in a vacuum. Leaders have to relentlessly scan the external horizon for regulatory, economic, and competitive storms. To do this, they rely on two absolute staples. First up, the PEST framework, analyzing politics, economics, society, and technology. This essentially tells you what the rest of the world is doing. Second, Porter's 5 forces, which zooms right in on your specific industry's rivals, suppliers, and barriers to entry. By using these tools, leaders perform vital threat assessments and opportunity identification to fully map out that external battlefield before making a single move. Once you know what's happening outside, well, you have to look inward. Tools like SWOT and value chain analysis reveal your strengths. But the ultimate test here is the VRIO framework. And this brilliantly illustrates how finding internal assets is everything. It relies entirely on finding resources that are valuable, rare, inimitable, meaning, they can't just be easily copied by a competitor, and organized to capture value. These right here are your core competencies. If your internal resources hit all 4 of those marks, you've just found the foundation for a truly sustainable competitive advantage. So, you know your environment and you know your strengths, but how do you actually deploy them? Enter the Boston Consulting Group, or BCG Matrix. It's a fantastic portfolio tool that helps managers allocate resources across different business units by balancing growth, stability, and retrenchment strategies. Think of it like this. If you have a product in a high-growth market with a high market share, that's a star. High share but in a low-growth market, that's your cash cow, and that's what funds your other ventures. Now, a low share in a high-growth market makes it a question mark, which takes some careful investment. While a dog, low share, low growth, often leads straight to divestment or liquidation. It's all a big balancing act. Section 3. Fueling growth through capital budgeting, the financial engine. We're going to shift our structural metaphor now, leaving the brain of strategic planning and entering the wallet or the engine that actually funds all these massive ideas. Imagine having a strictly limited pool of funds, right? And you have to choose to back one incredible project while ruthlessly canceling another. That is the high-stakes reality of capital rationing. Capital budgeting is essentially the art of committing today's funds for tomorrow's returns. We're talking about long-term planning where decisions are heavy with financial weight, and, crucially, they are irreversible. Think about it. Once you build a massive factory, you can't exactly unbuild it to get your cash back. And because these decisions are so permanent, the deployment journey has to be meticulous. You start by identifying and rigorously screening all your proposals. Then, you roll up your sleeves and run the hard math to evaluate expected returns. From there, it's a battle for priority. I mean, if projects are mutually exclusive, picking one mathematically kills the other. You keep going until the absolute best investment finally gets approved. Now, financial managers have a pretty diverse toolkit to evaluate these projects, but let's be clear. They aren't all created equal. The payback period is incredibly simple. It literally just asks, how fast do we get our cash back? But it dangerously ignores the time value of money. The accounting rate of return uses profits, sure, but it misses the actual cash flows. That's exactly why net present value, or NPV, and the internal rate of return, IRR, are the real heavy hitters here. They bring in discounting, recognizing that a dollar today is absolutely worth more than a dollar tomorrow. NPV is especially reliable when your projects differ in scale or timing, while the profitability index refines that NPV to help you rank your options perfectly. Section 4. Navigating Risk and Uncertainty, Forecasting the Storms. Let's take a breath here for a second, because the grim reality is every single capital budget relies on wildly unpredictable future cash flows. Since we can't actually predict the future, financial leaders use some very specific quantitative tools to protect the company from real-world volatility. If a project is incredibly risky, they might hike up the discount rate, or mathematically scale down the expected cash to a sure thing using certainty equivalence. They'll run sensitivity analyses, looking at optimistic versus pessimistic outcomes to see what happens in a worst-case scenario. They'll use probability-based valuations and map out the wild swings in potential returns using strict statistical measures like standard deviation. Let's move to and see how this builds, especially when you have sequential choices stretching over several years. Standard formulas tend to fall short there. That's where decision tree analysis comes in. Managers map out choices and their probabilistic outcomes just like the branches of a tree. It allows them to visually map out multiple futures and navigate incredibly complex, multi-stage investment paths without getting entirely lost in the math. Section 5. Executing the master plan from paper to practice. Okay, we need to zoom back out from the intense financial math and look at the messy human reality of implementation, because strategy on paper is completely useless if you can't actually execute it. Execution is notoriously difficult. It's usually plagued by poor planning and dragging morale, but perfectly aligning the elements of the McKinsey 7S framework is pretty much the only known cure for that resistance to change. It argues you must perfectly align 7 internal elements: strategy, structure, systems, skills, staff, style, and shared values. Think about it. If your strategy demands rapid innovation, but your structure is heavily bureaucratic, and your shared values punish failure, yeah, the plan's going to collapse. They absolutely must work in perfect harmony. And once the organization is actually aligned internally, we have the outward execution. It's so important to highlight here that marketing isn't just about running clever ads. It's the outward, customer-facing reality of the entire strategy we just built. It is quite literally about creating, communicating, and delivering value to anticipate and satisfy customer needs way better than any of your competitors can. Section 6. Rewarding the shareholders, the final harvest. We finally arrive at the last massive structural hurdle. The strategy worked, the investments paid off, the company has made money. Now, do we keep the cash to grow even further, or do we pay it out? And this creates a truly fascinating academic showdown in financial theory. On one side, we have irrelevance theory, championed by Modigliani and Miller. They argue that under perfect market conditions, dividend policy doesn't actually affect the overall value of the firm. On the other side, though, is relevance theory, championed by Walter and Gordon. They insist that dividends absolutely matter, leaning heavily on Gordon's famous bird in hand argument. This stresses that investors strongly prefer the near certainty of immediate dividends today over the risky, uncertain promise of capital gains tomorrow. So, how does a firm actually decide who gets the cash? Well, they have to weigh current company earnings, firm liquidity, taxation rules, and what their shareholders expect, all against future financing needs. So, the crucial point is beautifully summarized by Walter's model. If your company's returns on investment actually exceed its cost of capital, retention is better. Keep the money and grow. But if your returns are lagging behind the cost of capital, paying out dividends is the winning move. You're constantly having to balance investor wealth with the firm's growth. We've built the vision, scouted the battlefield, fueled the engine, mapped the risks, aligned the team, and debated the harvest. It really all comes down to this final, delicate, high-stakes balance. Your strategy is set, your capital is deployed, but are you creating value or just surviving? Thank you so much for exploring the dual corporate engine of strategy and finance with me in this explainer. Keep questioning the blueprint, and I'll see you next time.